Good afternoon, everyone. This is a live webinar from Wilder Brokers headquarters in Limassol, the one just a few days before the final round of French election, a long-awaited event that was about at the early stage to shake Europe seriously. Now, when the things got clearer, the initial strong tensions that were building around the fears of possible victory of far-right candidate Miss Marine Le Pen, who was supporting leaving France leaving from European Union, so-called Frexit, kept markets under strong tension. At the few days before the election, the second and final round, where Mrs. Marine Le Pen and Emmanuel Macron will face each other. We had a debate, TV debate last night on Wednesday, which was the last time that both candidates met before meeting next time in final vote on Sunday. Just a quick look at the polls showing that Emmanuel Macron has actually, the difference between them has slightly narrowed, but still remains within expected levels. Most of analysts saw the Macron winning the Sunday's round with around 20% advance against Le Pen, and this is what it's showing. If we just take a look at this graph, the difference was steady, somewhere around 20%. And widened just days before the first first round vote on 23rd of April, and again now narrowed back. Le Pen has 41% of votes, just a few days ahead of final vote, and Emmanuel Macron is holding firm at 59%. The key event was Wednesday's final debate, which, as I said, is the last time the two candidates face each other before Sunday's vote, and it was badly seen from the media and analysts as the mutual accusations highlighted the meeting. Presidential candidate Emmanuel Macron strengthened his position, however, after this meeting, and being a front-runner after a clash with Marine Le Pen. And as I said, analysts, newspapers and polls see the centrist candidate as the most convincing and the likely winner, as these are the latest polls and expectations in France ahead of Sunday's final vote. Both candidates were hoping in this debate to make an impression on the estimated 18% of undecided voters in the first election the country had ever held without candidate from the two traditional mainstream parties. This is actually quite strange. It's the first time happened in the history. But current situation in France is just emerged these two candidates out. The candidate from the National Front, far right, Marine Le Pen, used as her opponent also quite rough language, accusing Macron of being the candidate of, as it says, savage globalization, and said his version of France is a trading room where it will be everyone fighting for themselves. Of course, Macron responded saying that Marine Le Pen openly lied, proposed nothing, and exaggerated the concerns of the public. Also saying that measures she proposed eradicating Islamic fundamentalism by shutting down extremist mosques and expelling preachers of hate were snake oil that played into terrorists' hands, and desire they had for a civil war. So the comments that were seen on the day before today from the media saying that this is unprecedented brutality. Comments from the press. Le Figaro saw Mrs. Le Pen adopting a strategy of total war that consisted of bombarding her opponent without respite. Mr. Macron, it says, dominated his opponent on economic issues during the debate of unprecedented brutality. Liberation accused again Le Pen of drowning the debate in the avalanche of disinformation, and publishes a list of what it says are false or exaggerated statements made by her. Le Monde also comes down on the side of Mr. Macron, who the newspaper says repeatedly denounced the nonsense by the candidate of the National Front, often rightly. So most of the things are in favor of Emmanuel Macron, and the markets are basically now expecting a final result of the Sunday's vote to learn who will be the new president of the Fifth Republic. As I said, the fears that were initially in the markets about possible victory of Marine Le Pen have faded, and you can see on the reaction of the market, this is Euro-US dollar pair. Previous weeks beginning, this was after the first round on 23rd of April, showed strong gap higher in favor of Euro against US dollar, and the single currency managed to hold these gains. We're talking about over 200 pips gap higher that has been unfilled for a second week, showing that the strength of the Euro on this strong bullish sentiment is still untouched, and the Euro may strengthen further despite some events that happened or are going to happen in the meantime. It seems that single currency particularly is looking for results of the French elections for some stronger direction signals. We can see that price of euro-dollar has been entrenched with within this congestion since 24th of April. So nearly 2 weeks, the price had been completely directionless. 108.50 on the downside, 109.50 on the upside are the two levels that mark this range. On the downside, we have the 200 days moving average that was strongly underpinning, as technicals for euro-US dollar are firmly bullish and see scope for further advance. In addition, golden cross that was formed on cross of rising 10 days moving average over 200 days simple moving average is additional support for the euro, and 10 days moving average so far held today's downside attempts. Little impact was seen from yesterday's FOMC interest rate meeting, when the Fed was expected not to change rates, of course, but to give more signs, more hints about a possible rate hike in meeting of the FOMC in June, which is the mostly expected time for Fed to act and raise rates again, as they announced after a previous hike of the rate in December, that they may hike it 2 to 3 times in 2017. Initial reaction as the markets understood the comments from Fed that, by the way, did not say something significantly new or brought stronger hawkish tone. The markets understood the comment from a statement of Fed last night as hawkish and pushed the dollar higher. In this case, against against euro, US dollar did not show some more significant reaction. It strengthened a bit. Euro fell down to approximately 108.80, which was the low of the session. A brief extension was seen this morning to 108.73, and that was all seen from Fed so far, as the pair remains supported and underpinned by rising 10-day simple moving average that maintains a strong boost to the pair towards 109.50, which is immediate barrier and pivotal point. We have the triple upside rejection at this point, and of course extension up to 110 level, which is psychological barrier. And in case the price breaks above these levels, we can expect it up to 111.27, which is 61.8% retracement of this larger descent from 116.14 peak of May 2016 down to 103.39, which is the low of January 2017. As said, technicals remain quite supportive for the single currency at the moment against the US dollar, and scope is seen for further upside. The price action is basically looking for firm break above 109.50, pardon, 110.00 for extension towards weekly cloud base of which is at 110.67 and cloud twisted lower. That may attract the price. Usually cloud twist is seen as a magnetic for prices to retest it. So far we are looking for reaction on tomorrow's non-farm payrolls that may also give additional boost to the single currency, or conversely may press the single currency depending on the release of the non-farm payrolls. Non-farm payrolls are forecasted around 189,000 for the month of April, which is almost double from the previous month downside surprise at 98,000, which basically surprised the market's expectations. Were stable in the past couple of months in the zone around the 180,000, and the downside surprise did not basically show much of the did not trigger much of the worries in the market, as non-farm payrolls could vary depending on the weather and the other factors, and they could just make certain spikes in certain months, but generally is still stable. The labor market in the United States is still stable, and the expectations for labor market are to go in a steady ascent. What we expect is around 150 to 180,000 on tomorrow's release, and in addition we see that the non-farm payrolls may stay around 150-180 zone in next couple of months before starting going higher. So these are the two the most important events ahead of Sunday's final vote. To see the impact, full impact of yesterday's hawkish tone of US Federal Reserve, we can take a look at the chart of euro against, of US dollar against Japanese yen. The dollar had maintained a strong uptrend since mid-April 2017, somewhere from 108.11, which is the lowest of 17th of April, and continuing to advance higher. Yesterday's rally came after extension higher came after the Fed announcement of Fed's interest rate decision and the subsequent statement that followed. Just to repeat, Fed did not say something spectacularly new, seeing that labor market is still in very good shape and expected to gradually increase, while inflation is seen hovering just under its target at 2%. Pardon. That is good and supportive for U.S. Central Bank for making decision of June's rate hike. That kept actually investors in a bullish mode after the meeting, and jumping firmly into the dollar. This is the best sample US dollar, pardon, against Japanese yen. So yesterday's strong rally penetrated into widening daily Ichimoku cloud, and today's action probed above cloud. What is important to mention from technical point of view is yesterday's close above this level at 112.67. That marks Fibonacci 61.8% retracement of larger descent from 115.49 down to 108.11, and close above this usually gives good bullish signal for possible further advance. In addition, the price action probed above daily cloud top, which currently lies at 112.85, and also briefly cracked psychological 113 barrier, which is reinforced by this bear trend line that connects peaks from 118.59 and 115.49. Now it's from tentative, it became a firm trend line, and there are attempts to break it in case the price closes above the trend line resistance and above daily cloud top. That could signal that dollar against yen can extend further up on this strong bullish sentiment. Of course, a lot depends on tomorrow's release of US jobs data, as most of analysts expect that any release above 150,000 or even better above forecasted, forecast varies from 180 to 195,000. Anything above this would be seen as very bullish and would give a strong boost to the US dollar for further extension. So we have targets at above this at 113.75, which is Fibonacci 76.4% retracement of the down leg from 115.49 to 108.11. So the situation for dollar remains quite bullish. If we take a look at the technical studies, then we have multiple bull crosses of the moving averages, which are all now heading north. All indicators are in the positive territory, although the overbought slow stochastic on daily chart warns of some hesitation, at least, if not consolidation or correction. So far, we don't have any bullish signal as the indicator continues to move slightly aligned upside in the strongly overbought territory, unable so far to produce a stronger bearish signal. But pardon, this should be anticipated in the near term, as any strong move always requires some correction. As we can see at the moment, another resistance that did not show on the previous chart is 113.26, 100 days moving average on the daily chart, which now turned into descending mode, and the firm break of this will open this Fibonacci 76.4% barrier at 113.75. Quick look at Ichimoku studies. Broken cloud top marks immediate support at 112.85, followed by daily cloud base at 112.14, and also on the weekly chart we have some very strong supports. 111.80 is broken weekly Tenkan-sen line that was taken earlier this week, and of course previous very strong resistance now acting as support. Weekly Ichimoku cloud top at 111.36. That should contain any stronger dips, which seem unlikely so far, but in case of more negative outcome from tomorrow's non-farm payrolls, this cannot be completely ruled out, as in case that non-farm payrolls fall below the expectations. Of course, we have to see the other relevant indicators that are due to be released at the same time. The most significant are average earnings as well as unemployment. Unemployment is in steady descent since the last quarter of 2009, and they hit the lowest since 2007 at 4.5%. Forecast for Friday is at 4.6%, slightly higher, while average earnings are expected to tick higher to 0.3% in April compared to 0.2% in the previous month, March. So overall forecasts for non-farm payrolls are positive. All jobs data, basically, not just non-farm payrolls, are positive for the US dollar, and in case release comes along with expectations, then we can expect some stronger moves of the US dollar. Another good sample is Australian dollar that lost ground against its US counterpart yesterday, and also extended the bearish acceleration today, hitting low at 73.83. This is the lowest since November 2016, pardon, since January 2017, I do apologize. But what is important that this move also cracked Fibonacci 61.8% retracement of larger ascent from 71.63 to 77.47, and the strong bearish acceleration is now threatening for further downside. What also helped to accelerate this move were a release of Australian data during the Asian session today, when trade balance data showed the surplus for April at 3.11 billion Aussie dollars, missing the forecast for surplus of 3.33 billion, and upward revised previous month's release of 3.66 billion Aussie dollars surplus. This was a negative impact for the Aussie dollar, which was also accompanied by Chinese data services PMI from China, which is one of the, actually it's the biggest trading partner. Australia is the biggest trading partner for China, and vice versa. Also pressed the Australian currency. Services PMI came at 51.5%, pardon, 51.5 in April, well undershooting the forecast of 52.6, and the previous month release at 52.2. Now, from technical point of view, as we can see, all the moving averages are in steep descent and north. Several bear crosses formed, and double death cross of 20 and 30 moving averages that crossed below 200 days moving average, showing that strong downside pressure persists. As yesterday's long bearish candle, this is the biggest one-day loss since mid-September 2016, showing that Australian dollar came under strong pressure due to data from Australia and China, also due to stronger dollar after Fed, as the greenback again is regained fresh traction after hopes of Fed hiking rates in June boosted and prompted the investors to jump into long dollar positions, as a strong risk appetite appeared in the markets after release of the first of the results, pardon, of the first round of French elections on 24th on 23rd of April 2017, and boosting the appetite of traders for riskier assets and exiting those that were used as safe haven. Japanese yen was one of them, and the other one was yellow metal gold, that also benefited on the initial fears from before the elections, before the first round of elections. This is the daily chart for spot gold. We can see a strong bearish acceleration that started yesterday. Of course, there is a downtrend since 12.95 at 17th of April that extended on Monday down to 12.54. There was a pause, pardon, on Tuesday there was a pause shaped in this long-tail doji, but yesterday's acceleration after Fed statement pushed the yellow metal significantly lower. As known, yellow gold is quite sensitive to the changes in US interest rates, and usually reacts in opposite direction of US dollar, meaning that if US central bank hikes rates, that will be supportive for dollar, and gold will likely fell further down. Now, we had a forecasts for today showing that 1234 was initial, 1234, 1229 were initial targets. 1229 is Fibonacci 38.2% of this entire recovery leg from mid-December 2016 low at 1125 up to 1295, and the other one it was marking Fibonacci 61.8% retracement of uplift from 11.95 to 12.95 at 12.33. Both were met and broken, and the price also penetrated into widening daily Ichimoku cloud. The cloud top is today at 12.34, which was reinforcing this Fibonacci support, and the price is now looking for 12.22 cloud base, and in extension 12.18 Fibonacci 76.4% retracement of 11.95, 12.95 ascent. Technical studies remain firmly bearish. We also have the break below the main bull trend line drawn off low at 11.22, connecting it with the next higher low at 11.95. It was taken at 12.38, and now yellow metal price is heading lower, again on track for a strong second straight bearish daily close that could further press the price lower. Next target should be around 12.20 and 12.22, as we mentioned previously. 12.22 is cloud based, 12.20 is 100 days moving average, but the price can travel even lower in extension of the current strong bear leg that accelerated after decision of U.S. Central Bank, and the hawkish tone that followed, meaning that investors are now very convinced that FOMC might hike rates again in their June's meeting. That will further move widen the divergence between the U.S. Central Bank and the other world major central banks that are still at ultra low rates, and most of them on quantitative easing program, while the United States economy managed to recover and emerge out of the crisis. These are the few very significant signals that the crisis is likely over. The hiking rates stopping the bond buying program, so-called quantitative easing, pumping money into the market, you name it, and the hiking rates are the good signals for recovery of the economy, and wide expectations go for a further hike in June. Of course, tomorrow's release of U.S. non-farm payrolls data and the jobs sector data will be another crucial thing for the U.S. dollar, which in case, as I mentioned previously, in case of positive release at or above forecasts for all three significant releases, payrolls, unemployment rate, and average earnings, may further rally higher and press gold down towards, we said 12.22, 12.20, 12.18, which is Fibonacci level, and also can extend down to 12.10, which marks the base of a thick weekly Ichimoku cloud, where the price is currently moving. The bear leg from 12.95 actually commenced once the gold price failed to break above this weekly cloud top, and the subsequent weakness brought it at the levels where it is currently. The lowest of the session is 12.25, but focus is still shifted towards the downside. Another important and significant instrument is crude oil. Crude oil price eventually, we're talking about WTI crude oil, so-called US crude oil. The price managed to break below very important 47.07 former lows that formed a higher base, and in today's acceleration lower has finally taken out this barrier, completely reversing the rally from 47.07 to 53.74, and showing a strong downside pressure for further action lower. There are several factors that are pressing the oil price. The main one is basically fears of oversupply, as despite attempts of OPEC and non-OPEC members, key oil producers, to cut the oil production for first 6 months of the year, which is already implemented. We're talking about 300,000 barrels per day, but aim was to extend it for another 6 months, so from June onwards until December. That would give more effect to the stabilizing oil price and hopefully pushing it higher. But opposite scenario exactly happened, as fears of oversupply that was also boosted by a strong increase in production of US shale oil that disbalances all attempts of OPEC to stabilize the oil market, resulted in a past, this is fourth consecutive day of steep descent. There was a pause last week after a first leg lower. We can see these long-legged daily candles showing that the price was wobbling within certain levels, but did not establish in the fresh direction until fresh direction came, and now we have a break below 47.07, which was our previous key support, and the price now may extend further down. If we measure the latest movements of the oil price, so if we take the last rally from 42.19, which was hit sometime in November 2016, to the highest at 55.22. This is a peak of year 2017. The price has just taken out its Fibonacci 61.8% retracement of this entire move. And this is also a strong bearish signal, along with the break below 47.07 higher base. That could be a good signal for further extension of the oil price. As we can see, there are no obstacles on the way down. The way is open down towards 45.27, Fibonacci 76.4% retracement, and this trough of end of November 29th of November 2016 at 44.81, which could be easily reached on strong bearish acceleration. The spot the crude oil is also affected by a firmer dollar, which is also one of the factors that keep oil prices under increased pressure. And today's fresh acceleration lower continues to weigh on the market, as the oil price is also on track for the third consecutive weekly close in red. That also generates a strong negative signal, and basically what we can see that fears of oversupply in the market, which is present for past 1-2 years, to manage to stabilize the price by reducing production. So far, this doesn't give too much effect in the market, and the oil price remains in a free fall for now. As said, we can see down to $42 per barrel quite easily. This will be all for today. We're going to see the result and outcome of Friday's jobs data from the United States, and Sunday's, of course, one of the key events, Sunday's final round of French presidential elections, where we will have a clearer picture, and we'll arrange next week again one live session and elaborate of the full impact of all these events and the market movements that were produced after everything was done. I would like to thank you all for attending our live sessions. You can always send us feedback and comments on the email that was presented at the beginning of the webinar, and or you can contact your account manager or anyone who is contacting you regarding these webinars, and send your suggestions and comments, and we'll be gladly answering to your questions. Again, many thanks for attending our session, and we'll talk sometime next week. Thank you, and good luck.